Cloud security, $31 billion debt, and new Tensor chips. Go or whoa?
Earnings per share beat about 94%. Revenue about 3% above expectations, up roughly 22% year over year. Gross margin near 60%. Stock up around 7% after hours.
That's markets paying up for execution. Cloud is maturing, security is timely, and management didn't blink on big bets.
Or it's a relief bounce. Big checks, thin proof. We've seen this montage.
Beat the number, raise the stakes. Stock wagged after hours. 9 brains, 1 golden retriever. Roll the tape.
I am Bruno. I think stocks go up. I always think stocks go up.
I am Mara. I think Bruno is wrong. I am usually right.
I am Nia. I connect the dots so you are well informed.
I am Eli. I read the numbers so you don't have to.
I am Grant. If it pays me every quarter, I am interested. If not, I am golfing.
I am Mira. I explain why the big picture matters. It always matters.
I am Q7. I do not guess, I calculate.
I am Walter. I am old enough to know that this has all happened before.
And I'm Sunny. I make sure none of that goes over your head. You are welcome.
Every search and ad funds their experiments. Yes, ads are the engine, but they're also building cloud tools and their own artificial intelligence chips. Suppliers include Nvidia and server makers, rivals are Microsoft and Amazon. If digital ads and corporate tech budgets stay strong, Alphabet taps multiple cash streams at once, and that supports payrolls, data center builds, and, frankly, the towns around those builds.
Stakes are big because they stacked several moves at once. Acquisition, borrowing, new chips, shipping those chips straight to customers. Let's open it up. And quick note for anyone new. When we say AI, that's artificial intelligence. Software that learns from data to do tasks humans normally handle. Okay, noses up. They bought a big cloud security shop, raised a mountain of cash, launched new Tensor chips, and promised to deliver those chips right into customer buildings. After Hours traders said, "We like it." Question, do these pieces lock together like Lego or knock each other over like dominoes? Let's sniff details before we chase the stick.
Facts first. First quarter revenue about $110 billion, up roughly 22%. Net income jumped around 81% to about $63 billion. Cloud grew near 63%. They lifted the dividend about 5% and guided capital spending this year to about $180 to $190 billion. Paid subscriptions near 350 million. Monster quarter.
That number has teeth. Woo!
They also made a dozen strategic moves. We'll focus on 5 that can actually move the stock this year or next, and keep the rest on a watch list.
The cloud security boost, the cash raise, the artificial intelligence power-up, the ship-it-to-you delivery option, and the Nvidia competition move with their own chips. Each one touches customers, suppliers, and rivals differently.
The market noticed. Post-market pop near 7%. Bloomberg framed cloud results as the hinge this earnings season for big tech.
CNBC lumped them with fast food and autos. Cute. Sentiment swung fast. Easy to swing back if proof doesn't show up next quarter.
Translation, great headline, now show the homework. Which move matters most?
The cloud security boost is the lever. In regulated industries, security is the keycard. Make it built-in and trusted, and the rest of the cloud workloads follow.
Bruno, that's the brochure. Show me numbers. Integration with their incident response unit isn't mapped publicly. They guided a small margin headwind in cloud this year. What if it bites longer and deeper?
Plain English, Mara says the shiny new security could dent profits before it helps sell more cloud. What number would calm that?
Look at attach rate, how often security is sold with compute. Then look at churn after a breach. If attach rises even 2 points and churn drops a point, regulated customers expand workloads. If attach stays flat, it's shelfware.
And that filters into daily life. Fewer breaches, fewer "your data was exposed" emails, fewer surprise vendor bills. That makes budget owners more willing to move more work to cloud, and it makes your employer less jumpy about outages on payday.
That's the 2010s Microsoft play. When they embedded security deeper in enterprise, trust spiked and adoption curves steepened. Buyers moved because the risk felt contained.
That analogy only lands if they scale trust at Microsoft speed. Big if. Publish case studies with dollars saved and outages avoided.
Watch the backlog. If remaining performance obligations accelerate and security is cited in the top logos, we have our verdict. Customers are signing with their wallet.
If security attach rises 2 percentage points and churn drops 1 point, then cloud annual run rate likely lands $5 to $7 billion higher within 8 quarters.
Translation: if enough customers buy security with cloud and fewer leave, the cloud line could be several billion bigger in 2 years.
We want management to start sharing attach signals, even one sentence on the call. 2 named case studies with spend growth would be huge.
Flag planted. Security first, but only if it sells the rest. Round 2. Do these decisions help each other or trip each other?
The artificial intelligence power-up and the challenge Nvidia chip push work together. If their custom chips lower costs for certain models and Nvidia supply stays tight, then customers can start projects sooner and cheaper without waiting.
Slower, please. That means if Google's chips are cheaper for some jobs and Nvidia's are hard to get, buyers won't stall.
Nia, if is doing the lifting. No independent benchmarks yet. No clean path to move code trained on Nvidia tools. If they don't publish outside proof with dollars saved, then buyers wait. Deadlines slip. Pilots die.
Mara, the ship-it-to-you option answers the waiting. Putting their chips in customer buildings means commitment and multi-year contracts. Even if revenue posts in 2027, today's signed deals show demand now.
Yes, but shipping hardware into customer sites lowers margin and raises service complexity. In a tight labour market, engineers cost more. That hits costs, while capital spending is already massive. If they overpromise on installs, support tickets pile up. That's payroll pain. Just like a restaurant short on cooks during a dinner rush.
Reminds me of Sun Microsystems in the 90s. They sold boxes plus strong service, won big logos, but lost flexibility when standards shifted. Owning the box is power until the standard changes. Then you own an anchor.
Fair, but with privacy-sensitive sectors, on-prem options unlock deals pure cloud can't. If they unlock healthcare and banks with this, they pull workloads they'd never touch otherwise.
So shipping boxes can get you into rooms you couldn't enter, but it can pinch margins if service gets hairy.
Reuters flagged it. The market rewards artificial intelligence spend only when proof lands. That's the hinge. If they show verified cost per task or latency wins, momentum holds. If not, the hype cools.
Eli, if independent tests show 20% better cost per unit of compute on common models, then adoption probability rises above 60% for new workloads within 4 quarters.
Fine. But look at the cash raise. 31 billion of debt. General purposes language. If we don't see capital spending on these chips step up within 2 quarters, then it was window dressing, not fuel.
Plain talk. If they borrow a pile and don't spend it on the thing they say matters, the story stumbles.
Sunny, enough poetry. What makes this stack hold for regular people who don't babysit servers? I'm trying to decide to buy or wait.
Grant, your paycheck and your grocery bill. If artificial intelligence tools cut costs per task, services can arrive faster or cheaper. If costs rise with no payoff, businesses raise prices or cut jobs. Proof decides whether you get faster service or higher bills.
And Bloomberg's take still stands. Cloud drives sentiment across the big 3. If Google's cloud keeps outpacing, the valuation grows. If it lags Microsoft or Amazon, money rotates away.
Eli, mispricing likely sits here. The security lift is undercredited. The new chips are overcredited. If we see a catch-up by year-end, current multiples understate 2027 earnings. If chip-proof lags, near-term optimism runs hot.
Mara, you keep asking for proof. Good. But security wins happen first. Close the door, then sell the house. Give me attach up, churn down, backlog up, and I'll ignore your size.
Bruno, put it in ink. Attach, disclose. 2 named case studies. Chip savings verified. Until then, it's a sizzle reel, not a kitchen.
Price check. Last close about $350. After hours spike to roughly $375. The uptrend is intact. We're around 7% above the 20-day average, 12% above the 50-day, and 25% above the 200-day. 5-day return, up about 3%. 20-day, up nearly 22%. Volume ran roughly 1.2 times normal. Buyers showed up.
Translation: momentum is strong, folks are piling in, but we're nose to nose with the ceiling.
Strong floors at about $300. Price bounced there 3 times. And about $275. Price bounced there twice.
If price holds above the prior high for 5 sessions on above average volume, then the chance of the uptrend continuing next month exceeds 65%.
The chart says buyers believe the story.
Or it says, don't chase a sprint. Have a plan.
Pause down, clean chart tour. Let's talk money choices.
Entry. Do I wait for a dip or nibble now? Simple.
If you're disciplined, scale. Start small, then add near $320 to $300 if we cool off. The sturdy plank is $300.
Normal words. If you want in, maybe buy a little now and hope for a better sale tag later. If it dips near $300 and holds, that's your bigger bite.
Position size. Percent of portfolio. No riddles.
Grant, given unknowns in on-prem installs and how they use that debt, cap it modestly now. You can raise it if we see proof, security attach rising and chip savings verified.
Our model says 10% max at full conviction. Start smaller while we wait for proof.
Translation. Don't make this your whole pantry. Start with the shelf.
Red flags. What trips the fire alarm and makes me sell?
3, 1. If that borrowed $31 billion just sits on the balance sheet while capital spending on chips doesn't step up within 2 quarters. 2. If cloud margin erodes beyond the small headwind they flagged and stays there 2 straight quarters. 3. If there's still no independent proof their chips save customers money by year end.
Add 1. If ship it to you slips, watch for slow customer acceptance and service overruns. That stalls 2027 revenue and ties up too many engineers in support instead of building.
Counter. If security attach rises and backlog climbs, you add, not trim. Don't overthink a working engine.
If cloud security attach is 2 points higher by Q4 and capital spending on chips rises at least 10% versus the first half, then fair value near $435 within a year looks supportable.
Translation. If the seatbelt gets bought with the car and the new engine actually gets installed, the stock can work from here. If not, it's more meh than meltdown.
That's enough. I'll stage in and watch 2 tells. Attach and ship spending.
Okay, final take. What's everyone feeling?
Security first, then chips. Win both, stock runs.
No proof, no party, bring independent numbers, or bring a helmet.
Backlog plus attached data is the cheat code.
Spend wisely, or wages and hardware costs bite paychecks.
If security calms tech buyers, cloud budgets open wider.
Past pivots rhyme. Execution writes the verse.
Evidence will decide.
I'm buying slow. Evidence buys me speed.
Here's the bone. Alphabet beat, spent big, and stacked security plus new chips. If security unlocks more cloud and chip claims get verified, this gets bigger and stronger. I'd act fast, only if attach moves up and we see real independent chip savings. I'd wait if the borrowed cash sits and cloud margins sag longer than they promised. Quick bite next. We circle back in 2 quarters, bring snacks and receipts.